Hello, my name is Carlos McWhorter, CPA, and today I'm doing a stock analysis of McDonald's. So the reason why I want to do this stock analysis is because they've had a E. coli outbreak. 75 people has been impacted over 13 states, and it caused their stock to slide about 8% over the past week. So I want to look at this quality business because it's not often that we get a chance to grab a quality business at a bargain. So I want to look at an intrinsic value to see what's a good price that I should be waiting to pull the trigger on this company. So we're going to look at the revenues, the cash flows. We're going to look at the balance sheet, the shares outstanding, and also we're going to look at the intrinsic value through a discount cash flow analysis and kind of get an idea of where we'd like to see this company at. So let's get right into it. So looking at the stock price over the past 5 days, like I said, 8% down, about 7.57% so far. Recent outbreak again, excuse me. So far. Other than that, we see that the stock has been doing pretty solid over the past 3 months and even year to date. So year to date, no, not so much. Sorry about that. Year to date has been pretty flat. We had this dip here in the mid-year, and then we have this uptrend and a quick downtrend over the past week. So we'll see how this continues to impact the stock. So let's get into the segments. This is how I like to start. So we always look at the business segments because we want to see how the business separates their revenues. How do they look at their business? How does management look at their business? So we have 41% of their revenues coming from the United States, 49% coming from international markets, and then we have the foundational markets and corporate activities at 10%. So McDonald's makes most of their money outside of the US. So let's look at their revenue trends briefly. And we see 2015, they were at 27 billion. They went pretty much down since then. So we have 27 all the way down to 19 and a little bit back up to $25 billion. So this is a company that is a very strong business, but we see that they are in their mature state. So typically, when we're looking at businesses, we always want to know the stage of the business. Are they in a early growth stage, a hyper growth? Are they in a mature state or stable stage? Or are they kind of at the top of the mountain? And McDonald's is one of those companies that's really at the top of the mountain. It's going to be very difficult for them to grow at a high rate without significantly increasing their prices. So this is where this company is. So this is understandable that their revenues isn't growing every year. So they do have some recent revenue growth, but we see that they're pretty much in a low growth state because they're very stable. Wherever there can be a McDonald's, there is a McDonald's. There's not much room for them to grow. So just looking at this chart, we can kind of see that they've had a downtrend, but kind of an uptick recently, and we'll see if they can continue to grow those revenues. But pretty much stable company, mature, top of the mountain. They've been there for a long time. I believe they'll continue to be there for a long time in the future. So not necessarily something that's alarming, but we have to keep that in mind. This company is not going to grow a whole lot. So if that's the case, we definitely want to get it at a bargain. So looking at the free cash flows. Oh, sorry, let's back up a little bit. One more thing I wanted to point out. So the revenues is not growing over the past 10 years. They're pretty much down. However, we do have the margins. 2015, we have margins at 38%. All the way to now, margins are at 56%. So the revenues are not growing, but this company is growing profitability because they're becoming more efficient. So this is great to see. So not so much here, but margins are improving at a great rate. So that's a great sign. So let's go to the free cash flows. So 2015, we were at 4.1 billion, 2024, 7.2. So it's consistent growth. So over the past 3 years, 15% growth. Over the past 5 years, 8%. It's pretty solid growth of the free cash flows. The balance sheet. Now, this is where we have to do a little bit analysis. So here's where I have to kind of back up a little bit. Of course, I like companies to have a debt level of 3 to 5 years. Be able to pay off their debt with free cash flow in 3 to 5 years. 5 years or less, 3 years is golden. But we see McDonald's is barely under 5 years. We have here in pretty much the last over 5 years. So over the past 10 years, only once have they been at a level where they can pay off their debt in less than 5 years. So I would say averaging 7.6, 6.7 in the past 3 years, I would say poor leverage, just looking at it first off of first glance. But you have to understand their business model. So McDonald's is going to buy and own the land. Then they're going to lease the land and lease the building to the franchisee. So there's going to be debt associated with the building, a debt associated with the land that's on McDonald's books. However, the franchisee is responsible through their rent payments and through royalties to take care of those debt payments. So it's debt on their balance sheet, but the franchisee is going to pay it through operations with the cash flow that they create from operations, and then they're going to pay off those debts. So this is a company, because they have land, I can understand them carrying some higher debt balances. So this is where, again, it's higher than I like, but it's given their business model, these numbers do make sense, and I don't believe it puts them at risk. So it is a check mark, but as you see in the scorecard, it's not a green check mark, but it's pretty good. So going to the dividend, let's look at their dividend policy or their dividend position as of right now. Right now, they're paying a 2.85% dividend, which is pretty solid and expected for a company of this maturity. So they're growing their dividend of 8.79% every year for the past 5 years. So that's pretty great. I kind of look at dividend growth rates as kind of comparing that to what people typically get from their jobs. Most people don't get an 8.79% every year. They don't get that raise every year, their jobs. We're looking at 3 to 5%. Most people, their job increase or salary increase might keep up with inflation. So this is definitely a dividend increase every year that is above inflation. So that's great. Their payout ratio, a mature company, I would expect it to be this high, probably somewhere over 50%. Still a lot of room to grow. So 62.5% of their free cash flow is being paid out in a dividend. So overall, I believe this is a great dividend policy for them, and pretty much the main incentive for investing into a company like this. Again, we saw the revenues and we talked about how they're in the mature state, so they're not going to be growing a whole lot. So if you were to buy McDonald's, I believe this would be the main reason, to get that consistent and growing dividend every year. So let's go to shares outstanding. All right, we like to see this. We like to see shares trending down. So this is when a company has so much cash flows that they cannot effectively reinvest the cash back into their business and get a higher return. So they'll start to take some of that cash. If it's not being paid out in a dividend, they'll start to buy back shares, reducing the number of shares. This creates more value for the shareholder because the company stays the same, but with less shareholders, the current shareholders, the remaining shareholders, own more of the business. So we like to see this. However, doing some reading on their share policy or their shares outstanding policy, I see that in conjunction to their debt balance, what McDonald's did is they took out a lot of debt when debt was cheap and used that debt to pay back shares or to buy back shares. So ideally, personally, some people think this is good. Some people think it's bad. I don't think it's necessarily bad, but I'd much rather a business buy back shares with cash flows from their operations versus taking out debt, even though the debt is cheap, and using that money to buy back shares. Yes, they can pay back this debt. Yes, their business model, they're stable. They have solid revenues and solid cash flows and growing cash flows. So they'll be able to pay off this debt. And again, they got it when debt was very cheap, when interest rates were very, very low. So it kind of makes sense. At the same time, I'd much rather they don't do this. And if they were going to take out debt, they use it for operations to grow the value of the business. However, this is why, or one of the reasons why this debt is higher over the recent years, is because McDonald's took out debt very cheap to buy back shares. So this is why we see an aggressive downtrend of their shares. So keep that in mind. They are increasing value to the shareholder, but they also have more debt on their balance sheet because of this. So some people may see it as a wash. I kind of see it that way just because that's money that they have to pay back. But again, interest was low during that time. So we'll see how that plays out. But just looking at the shares outstanding by itself, this is a great sign. You definitely want a stable company to take cash flows and do this. So looking at the economic value added. All right, so what I like to look at is the returns on capital. Capital meaning their debt and their equity. What is the capital structure of the capital that they have that they're using to create a return in their business? Right now, McDonald's is earning 22.8% on their capital. That's a very high return on capital. Their weighted average cost of capital, because a lot of that debt came in during a time where interest rates were so low, very low, 1.14%. It's probably the lowest that I've seen in a while. So right now they are pretty much creating value in their business, in their operations of about 21% a year. Compare that to the industry, as far as the restaurants industry that they compete in, very high, still return on capital 19%, but McDonald's is beating the average of their industry. And also weighted average cost of capital, much lower. So they have a spread of 11% over most of their competition, over their average position of their competitors. So they are adding more value to their business than their competitors on an annual basis. So that is another great sign for McDonald's. So now let's look at the discount cash flow to see what we think about their intrinsic value. So looking at some analyst estimates, they're estimating about a 5% revenue growth over the next 5 years. The discount rate is very low because their cost of capital, or the weighted average cost of capital, is very low, so 1.6%. And because it's a stable company paying a dividend, I believe it's a stock that's going to be in demand in the future. And I believe the company is going to continue to have a strong position. So I believe that if I were to buy this company today and sell it 5 years from now, I can sell it at a multiple of 20 times free cash flow. With these assumptions that I put in, right now, McDonald's is worth $233. They're trading at about $292. So it's about a downside of 20% based on my analysis. Now, again, this is an art. This is not a science. This is not 2 + 2. I'm making guesses and assumptions about the future that I believe are reasonable to give me an idea of what this stock is worth. Now, if you are only investing into McDonald's for the dividend, maybe this doesn't matter as much since you plan on holding it for a long period of time to receive that dividend. But again, if you're going to do that, or you still want to own the stock for the dividend for the strong and stable company, it's definitely in a stock that you can dollar cost average and benefit from in the future. So if you're a dollar cost average person, don't pay attention to this valuation. If you are a lump sum investor, this may not be the best time to invest in a company like this. I think there are better opportunities for that. Again, 20% downside based on my analysis. You may think this is going to be higher. You may think, hey, this is 25 times free cash flow is a better multiple. But just for just double the growth rate, just to see how sensitive this analysis can be, to give you an idea of, or just someone out there that might believe that my growth rate estimate is too low. They may say, hey, they're going to grow at 10%. That puts you only 5% off of the price at $276. So depending on what your growth rate is and your assumptions, this could be a decent value or you're close to it. So given a summary of what we just discussed about this business, revenue and margin trends, they're going in the wrong direction for my liking personally. I want a company that's growing unless I'm investing into a stable company just for the dividend. But overall, I give that an X. Free cash flow is great. Balance sheet, higher debt than I like to see, but because they took out that debt at very low interest rates to pay down, to buy back shares, and also because a lot of their debt that they have according to their lease agreements is going to be on the obligation of the franchisee to pay, I gave it a check mark, but again, it's orange, not a green check mark. The great dividend policy, they're buying back shares, creating value at a much higher rate than their competitors, but a little bit overvalued right now. So that's my scorecard of McDonald's right now. So let me know what you think in the comments of McDonald's. Do you think this is a great investment right now, a great dividend play? Do you believe there's more growth opportunities, more than I assume at 5%? Let me know in the comments, and I hope to see you in the next video.